All right, let's talk about the top 5 audit-proof tax strategies that can save you money as a small business owner. I'm going to hit all 5 of them here today. I want to make sure you're adding these on your tax return. This is going to put more money into your pocket. All right, let's hit tax strategy number 1. I'm going to be whiteboarding here back and forth. We're going to be throwing some numbers out, putting some real meat on the bone, so to speak. Strategy number 1, LLCs do not save taxes. S-corps will save taxes. If you're a small business owner and you're like, I got an LLC, Matt, I'm saving taxes. No, you're not. LLCs do nothing in terms of tax savings, but you can add an S election to that LLC, or you can set up an S corporation. I have an S corporation that I use to get all of my income that's ordinary income. Now, what we're talking about here, and I'm just going to diagram this out. Let's go. We call this our trifecta, by the way. This is you down here. And up top are the things that you do. Over here is your investments. And over here is where you're making money or your operations. Now, let's say you small business owners, you're over here. You may have an LLC that you own 100%. It's out there making money. It's got some expenses. We're going to hit all those here in a moment. But if you're making more than $50,000 a year net, after any expenses that you have, you're taking home $50,000 net income, you need to be using an S corporation. Let me just give a quick example. Let's say you have $100,000 of net income. Let's just say you have an LLC, a regular LLC, or let's say you're a sole proprietor and you're taking home $100,000 of net income. Well, that $100K goes into your taxes, whatever tax bracket you happen to fall into. Maybe your spouse has some income, you have some other investment income, that sets your tax bracket. But before you even get to your taxes, when you are self-employed, because you own your own business, you pay self-employment tax of 15.3%. 15.3% of 100K is $15,300. $15,300 is going to the IRS into Medicare and Social Security even before you pay income tax. Now, how can I save on that? The strategy is an S corporation. And what you're going to do is now I'm going to take that same 100K, and rather than paying $15,300 on it, I'm going to take that 100K, drop it into an S corp, or this could be an LLC taxed as an S corp. So if you already have an LLC and you're like, ah, crap, I have an LLC, Matt, how can I get this tax saving? You do what's called an S selection to the S corp. So we're going to run that same 100K through the S corp. Now what you're going to do is what's called a salary dividend split, or sometimes salary net profit. So over here, I've got salary. Over here, I got dividend or profit. Now on the salary side, the IRS says you have to take a reasonable salary out of an S corporation. So here I might take a $40,000 salary and I'm going to push through $60K of dividend or profit over here. Now, why would I do this? Why would I go to the headache and hassle of paying myself a salary and then considering another piece of it dividend? Because I pay no self-employment tax over here. I'm going to pay self-employment tax here on my salary, 15.3% of $40,000. That's like $6,000 that I'm going to pay in self-employment tax by using an S corp on the 100K. But the 9K over here, I don't pay. It's exempt, coming out of a dividend or profit. Now, I've got other videos on this. By the way, I showed you how Joe Biden uses this tax strategy. Joe Biden uses this tax strategy. Remember, today, audit-proof tax strategies, okay? If the president and first lady are using these tax strategies, you should too. This is a no-brainer. You will pay less tax by using this strategy. All right, do we got a question on point number 1?
We do. Shaolin31 is asking, I filed an extension for 2023 to October 2024. Can I still convert my LLC to an LLC tax as an S corp for 2023 if I didn't take out payroll during the calendar year 2023?
No. I hate to say that, but no, there's nothing you can do for 2023. You would have had to do a W-2 by January 31st of 2024. There's nothing you're going to be able to do till 2023. Your only option is to get a DeLorean, find plutonium, drive at 88, or I think it's 86 miles per hour when the clock bell hits whatever, and then go back in time, make the S selection. But otherwise, no dice for 2023. However, you should act now for 2024. Make the selection now for January 1st, 2024. Start taking the money out and start doing payroll. That is the number one thing you need to know here once you have the S Corp and you set the structure up, is now you're doing a payroll report every quarter. This is easy. At our law firm, we send clients to ADP. You could have your accountant do it. There's lots of Main Street tax pros that do this. It's not expensive. You might be paying $100 or something a quarter. But the tax savings will by far pay for this. Now, if you're like, Matt, I'm making $10,000 a year net after everything I can write off, maybe this is a side hustle or it's a newer business, you got a lot of expenses, don't worry about this yet. You could ease into this. But if you're like, Matt, dude, I'm doing the 50K plus net income, I need to get on the ball here, I've got an LLC, you can make the election now and go back to the first of the year. You can always go back to the first of the year, but we can't go back into a prior year. All right. So like Shaolin's question, I'm not going back into 2023. We're in 2024. So we're going to work with what's there. All right. Any questions on the S Corp here pending? Okay, let's jump to tax strategy number 2. I'm coming at you fast today because I want to make sure we get all of these out. And I also want to make sure I have time for your questions as well. Tax strategy number 2. Meals. We all got to eat, right? And one of the biggest expenses that you should have as a small business owner is you're going out and meeting people. You're going out recruiting. You're talking to people. You're meeting with vendors. You're meeting with potential clients, existing clients, potential employees or contractors, people you might be working with. If you're having a meal, that's an expense. Now, those meals I mentioned are a 50% write-off, okay? So if you spend $100 on that meal, you're only getting a $50 deduction. But this is clear cut in the tax code. This is very audit easy. You just have to establish what was the business purpose of the meal. If I was at a meeting or I'm trying to court a client or talk business with someone, that becomes a business purpose and that meal is 50% deductible. Now, an important tip here. There are meals that are 100% deductible. There is now 2 categories of meals and deductions. This is starting in 2023 since the rules changed. 2021, 2022, and before, it was all different. The rules all changed in 2023. We have 50% deductible meals that are kind of your typical meal with the customer, vendor, you're at a conference, whatever, that stuff's 50%. But if it is a company-wide meeting, maybe it's a team meeting, you have your agents or your employees or whoever it may be for maybe a monthly meeting or a quarterly meeting, the Christmas party, whatever it is, that is 100% deductible. Also, if the food is open to the public, maybe you have like a cooler with snacks or things like that, and it's open to customers and the public who may come by, that's 100% deductible. Otherwise, snacks and stuff in the office for yourself, or I should say for employees, is 50% deductible. So we kind of have that 50% or 100% deductible, but don't forget meals. This should be on your tax return. One of the great tax strategies that is actually a good business development strategy was a book out there called Never Eat Lunch Alone. That was a great lesson on making sure you're using that time to meet people, and why not? It's a 50% write-off. You got to eat anyways. It's a great way to prospect and grow relationships in your business. All right, number 3 here, auto. Auto is huge. It is a huge strategy, and this should be a big deduction. Now, this is also important for any of you real estate investors in particular, or many of you business owners that might have rental properties. That travel that you have to go visit the property, to see the property, to meet a contractor, to go get materials or supplies, whatever it may be. Any of you business owners going out, you're going to a meeting, you're going off site, that is all deductible auto expense. Now, there's 2 ways you get a write auto off. You either take mileage or you take actual. Now, in any case, whether it's mileage or actual, we're talking about business mileage. If you have an office or a storefront or a location that you work from every day and you're going from your home to that location, that's called commuting. That's not business mileage. But if you're going to Home Depot for your rental property, or you're going to a business lunch, or you're going to a meeting, or let's say you're a lawyer, you're going to the courthouse, you're a doctor going to the surgery center, you're the real estate agent going to a property, that's all business mileage, okay? We're going to be tracking that, and that's a write-off. Now for 2024, this is 67 cents a mile. Okay, I get 67 cents a mile. Let's say you're a real estate agent. You should have a ton of mileage. Okay, let's say you have 10,000 miles, right? You got to drive around, you got to show properties, you're going to list properties. Like real estate, a lot of times you actually have to go to, right? So there's going to be mileage involved in that. If you had 10,000 miles, that's a $6,700 deduction. Okay, if you had, again, 100,000 of income that year and 10,000 miles, that's going to be a $6,700 deduction. You really had, what is that, 92,300 miles? Okay, that's a big difference. Excuse me, $93,300 is really what you had there. And so that reduces my taxable income that I pay tax on. Mileage is the easiest. And mileage is like, hey, Matt, I have kind of my regular car I drive, and maybe I got a side hustle and I drive, a couple thousand miles a year on it for business. Just stick with mileage, okay? It's 10%, 20% total use of that is mileage. Just stick with mileage. Now, on the other hand, let's say that you're a contractor, you have a truck, or let's say that you have a business where more than 50% use of that auto is for the business, okay? If that's the case, you have the option of taking actual. It must be 50% or more business use. And now I can take actual expense. Now, actual can be kind of a pain in the butt. Now we're tracking the gas you put in the car, the insurance costs, the maintenance and repairs. And so, for example, if all that stuff added up at the end of the year and it was $10,000 and 70% use of the car was business, 7,000 of those expenses are a deduction. Now, for a lot of people, mileage is just easier. It's easier to track, and it actually gives you a pretty good bang for your buck. But when do we like actual? If you're buying trucks or SUVs, you can take bonus depreciation. In addition to your regular expenses, you get to take on the auto, and this can accelerate a write-off. So right now, bonus depreciation for 2024 lets you take 60% of a bonus accelerated depreciation of the cost of the vehicle that can create a much larger deduction to you that you can use on your tax return now. So as tax lawyers, we're always getting the question from clients, they're at the auto lot in December and they're like looking for a big write-off at year end. They're like, hey, I'd really need this new truck or SUV for my business. And I'm like all in for saying, go for it. It's an awesome write-off. You can take the additional bonus depreciation, which by the way, used to be 100%, went to 80%. Now it's at 60, which is still great. This is accelerating a huge depreciation, going to create a big write-off for the purchase of the car because we get it depreciated ahead of time rather than over time. So for example, let's say you bought a $50,000 truck. Typically you might take $5,000, $7,000 a year over time, but you get to accelerate that to take, say, 60% of that $50,000 purchase in year one. And that creates a huge deduction, whether you finance it or pay cash for it. Either way, you get a huge upfront deduction. So this becomes a great year-end tax planning strategy. But now what happens when you do actual, now you're not tracking mileage anymore, you're tracking the expenses of the auto over time. Now we've got a lot of other podcast episodes and a lot of other content on it, but I want to get you the 5. So number 3, there you got it, is auto. Remember, you got 2 choices: mileage, keep it simple and easy, or we can go actual, which you might want to consider if you're buying a truck or SUV over 6,000 pounds, because you can get that bonus depreciation. All right, you have a question here?
Yes.
All right.
If I am consulting, working predominantly from home, can I write off miles from my home office to the client site?
Yes, you can. So if you're traveling to see a client or the client site, that is business miles, even if it's from the home office or whether this is from your, you have a office in a commercial office building. Same thing, because you're traveling to the client site, that is going to definitely be business miles. So make sure you're tracking that. You're definitely going to get a write-off there. Consultants are another one, especially because you are going on site a lot of times, or maybe you're going to an off-site meeting place, as long as it's not your office. So frankly, for those of you that have a home office, I almost think all of your travel is deductible because no one's coming to your home office, right? You're not commuting from home to your home office. You're walking around, down the hall around the corner into the home office. And so everywhere you go from there, you're going to buy supplies, you're going to a meeting, you're meeting a client, outside the home office. Those are all going to be business miles. So that's a real nice feature. Okay, number 4 here, the number 4 tax strategy. I got the numbers right, the 401k, and we're talking about the solo 401k. Big opportunity here for tax savings, totally legit strategy. The IRS even has specific guidance and forms and process on this. The solo 401k is the best 401k plan for those of you self-employed with no other employees. This is a specific 401k the IRS created to say, hey, there's no other employees, it's just you. Maybe you've got some contractors or some part-timers or a partner or a spouse. That's fine. You can just do your own 401k just for you, business owner. Now, by the way, if you've got other employees, lots of other employees that are full-time that work for you, that've been there longer than a year, they're not partners, they're not family, you need that other type of 401k, the more standard 401k. But we have so many self-employed clients, the consultant, the realtor, the contractor, the real estate investor. I don't care what you are, but if you have no other employees, full-time, W-2 people, you can do this solo K just for you. Don't have to worry about adding other employees. Here's why it's cool. You can put $69,000 a year of contributions into a solo 401k. If you're doing an IRA, you can put $7,000 a year into an IRA. Now, I get this from self-employed clients all the time. They're like, Matt, I don't have a 401k. I'm self-employed. I don't have a company that set a 401k plan up and gave me forms to enroll and did a match and all this. Like, I didn't have that. I didn't go work in corporate America. I'm an entrepreneur. I'm self-employed. It was all up to me, and I didn't go set one up. Okay, here's what you need to set up. It's a simplified version. It's just for you, and you can put $69,000 a year in it, 10 times the amount you could just do into an IRA. Now, the solo 401k, by the way, you can self-direct. You could buy real estate, invest in private companies, crypto. You're not just stuck to mutual funds and stocks. I mean, you can invest in that stuff too. But all these other alternative assets are available to you, whether it's using an IRA or a solo 401k. We've got tons of other videos and content on that, of course, how that works. But I can get $69,000 a year. Now, you can decide, hey, Matt, I want to do that all as traditional dollars. Okay, you can do that all as traditional, and you can get a $69,000 deduction. That's right. If I put $69,000 of contributions into my solo 401k, that creates a $69,000 deduction on my tax return. Now, the way you get the money in, there's 2 ways you put the money in. This is the calculation of how the solo K works. You have what's called an employee contribution and an employer contribution. I'm writing this shorthand. That's terrible. Okay, on the employee side, you get to put 23K in. On the employer side, you can put 25% of whatever your W-2 is. Or if you're a sole prop, whatever your net income is, and it's actually 20%. Come back to that here in a moment. All right. So when you think of a 401k, a lot of people think of a 401k, hey, I work at a day job. Maybe I work at Dunder Mifflin, and Dunder Mifflin's got their 401k plan. And, I go enroll and I put money in as the employee, and then Dunder Mifflin does a match for the company match. And that's how most 401ks work across America. The solo K is the same, except it's on steroids, because you can be as generous to yourself as you want because you happen to own the business and are the employee. So let's just juice it and get as much money in as we can. So what you can put in as an employee is $23,000. As long as you make $23,000 and have a W-2 for you S Corp owners, which, by the way, we talked about tax strategy number 1. If you're making more than $50K or more a year, you should have an S Corp. So I expect down here, if you're doing a solo K because you're self-employed, you have an S Corp, which means you're going to have a W-2. All right, so let's say that your W-2 was 40K, like we used in that example above. Okay, I took a W-2 for 40K. I took out 60K too in dividend, but the 401k contribution is off of your W-2, which I want to make as low as possible up here to minimize my self-employment tax. But it comes into play again back here on how much I can put in my solo K. So 23K, since I made more than 23, I can put in 23. So I'm going to do a 23K employee contribution. Okay, that's employee. Then I get to put in 25% of the W-2 as the employer. Well, 25% of 40K is 10K. So I have a total of $33,000 that I can put into my solo K. Now, remember, you actually made 100K in that business, but we did the salary dividend split and took 40,000 as a salary, 60,000 as a dividend. And you get to put in $33,000 as a contribution that year. If you want to max out and get up to the $69,000, your W-2 needs to be around 170,000-ish or so. But as you can see here, you can still get 33,000 a year into the solo K off of only a $40,000 W-2. That is still like almost 5 times as much as you can put into an IRA. So it's a pretty awesome strategy. Again, you can take an entire tax deduction on that, where that whole 33,000 is all traditional dollars, reducing your taxable income down. Again, let's say you had $100,000 of taxable income. That's going to take you down to $67,000 of taxable income. You're in a lower tax bracket now, and you got a huge deduction. Plus, that money is now set aside in a traditional retirement account that you can grow. Now, you could have also done Roth. Okay, Roth would have been an awesome strategy here. We love Roth accounts. That's for long-term wealth building. As I have Roth retirement account dollars, I do not get a deduction when I put the money in, but the money's growing and it comes out tax-free later at retirement. Different little strategy here. It won't save me taxes now, but it does save me taxes in the long run. So you got to decide what you want. Do I want tax deductions and tax savings now? I'm going to do traditional, and I'll pay taxes later when I distribute. Or do I want to bite the bullet and do some good tax planning now by getting Roth dollars in, and I'll wait later for the benefit because I can pull out the growth and everything tax-free on the way out. Okay, that's number 4, the solo 401k. All right, let's hit the number 5 tax strategy here, travel. Travel is huge, and I want to give a couple of examples how this plays in to your tax return. If you're going to conferences, you're going to meet someone, you're staying over, you're visiting a client, you're checking out a vendor, that is all travel. The airfare, and I'm talking about not auto type travel, I'm talking about airfare, okay, hotel, the meals while traveling. Even if you're in the airport by yourself, because it's for a business purpose, I still get a 50% deduction, okay? That is all deductible. Let me give you an example. I went skiing in Jackson Hole. Sorry, let me say that differently. I went to a business meeting in Jackson Hole and skied one day while I was there. Now, the airfare, all deductible because the purpose of that travel was business. I squoze in the skiing while I was there. The hotel stay while I was there, deductible because I was there for a business purpose. The meals while I was there, all deductible too. Now, there was a little extended time in the day that was more personal, and those meals would have been a personal expense and not deductible for business purposes. Also, if I stayed additional days, the hotel and the airfare, that you'd have to reduce the percentage of it that's for business purpose. But I squoze it all in, and I had the business meetings there, got the skiing in. Now, the ski ticket, of course, there's no way to write that off. Even though I was skiing with the client who I was there with, had definite business purpose up and down the lifts. That's what we were talking about. But that's a little too aggressive. We're talking about audit-proof write-offs. That one's not audit-proof. Don't recommend it. But everything else surrounding it, the airfare, like I said, the hotel and the meals, even while traveling, are deduction. Of course, the meals while I was meeting with that client were also deductible because that was a business meeting. All right, so those are the 5 top tax strategies. Remember, the S Corp and LLCs do not save taxes. Meals, keep in mind, there's 2 types of deductions that you have for meals. There's the 50% write-off, that's your typical business meal. And then there's the 100% business deductible meal for those of you with employees or a bigger team where it's more of a company-wide training or company meeting. Auto, you've got mileage or actual. Mileage is the easy one. I say 90% of our clients actually do mileage because it's simpler and easier to track. But those of you buying SUVs or truck, typically our contractor clients that have delivery service in their business, or some of our fancy realtor clients or stuff, that like to drive around in big trucks, that you can still write those off and take actual. That's the way you can get an accelerated deduction this year, as long as you have more than 50% business use of the auto. Then number 4, the solo 401k. It's a retirement planning strategy, which is long-term wealth building, which is awesome. We're going to invest and grow that account with tax benefits because I'm not paying taxes as I'm investing and growing that account. Even though I might getting returns or income, I'm selling a property or mutual funds or getting rental income, whatever that retirement account might be invested in. And then lastly, don't forget travel. Mix in some of that personal stuff and have fun while you're doing business travel, and all that airfare, hotel, the business meals, the meals while traveling. That's all a write-off too. All right, what questions do we got on topic, if any? I want to hit those. Anybody in the chat, please fire away. We've hit the top 5 here. As you're getting ready here, I just want to say one thing about this. There are 87,000 new IRS agents going to be employed. Tax planning is the way you keep money in your pocket. As I said at the outset of this, one of the number one expenses to a successful small business owner is taxes. You have to know how to plan around this to save. Do not be scared to do good tax planning. These 5 strategies are tried and true. You've got to have business purpose for this. We're not saying about writing this stuff for a hobby or considering personal meals as really being a business bill. I'm talking about legitimate business owners that miss these deductions, that are not organized, that are not paying attention to this stuff. These are write-offs and expenses you can take, audit proof, as you get into any disputes. If you deal with one of these 87,000 new IRS agents, you will win. All right, questions? Any in the hopper yet? On topic.
We got a couple, and all the IRS agents have guns now.
Oh, do they have guns now?
Yeah.
Well, there's the criminal division of the IRS, by the way, that does have guns. So that's if you've been really naughty. So
we got a question here on Instagram. Does the vehicle have to be registered under the LLC to write off the mileage?
Ooh, great question. No, it does not. In fact, don't do that. You don't need to have the auto in the name of the business. It could be in your personal name, whether you're doing mileage or actual. You don't have to. Now, you could put the auto in the name of the LLC, and I would recommend that particularly if you're a business that has, let's say you're a contractor and you have employees driving the trucks, or you've got delivery service, or even you're driving Uber, like the business is driving or something like that. That may be a case where for asset protection purposes, you may want the auto in the name of the business. But most of our clients don't put the auto in the name of their business. Their personal insurance, they may want to add a rider to say, hey, I'm using this for business use. For tax purposes, the IRS doesn't care. They just care what is the actual use of the auto. It can still be in your personal name, and it could be 100% business use, 100% business write-off.
Awesome. Okay, this is another one. This is going to be meals related. How do you prove the meals are for business if I didn't document throughout the year? Do I need the actual receipt, or is a credit card statement enough? What if my kids are present?
Okay. All right. Great question. Yes, you do need to keep a receipt and record. So grab the receipt. There's lots of apps and stuff. You can take pictures. You can keep the receipt. One thing I just personally do on my own is it's tracked on my calendar. I know all the business meetings I had on my calendar, and I know the purpose of that meeting. It says in my calendar notes what this is about. And so that's going to be a good record if you were audited. Why did you write off this $52 lunch? What was the purpose of that? Well, I can look at the date, tie it back to my calendar. Oh, that was with John Smith, and I knew the purpose of that meeting, and I wouldn't have used the business card, so to speak, for that lunch if it wasn't. And that's another good tip on a lot of these expenses here, particularly meals and travel, is make sure you're using a separate business account or credit card for business. Don't be using the same personal card for business stuff. Your bookkeeper and your taxes are going to be a nightmare trying to sort out, was that personal or was that business? But if I know when I'm at a business meeting, I use the business card, and when it's a personal meeting or personal lunch or something, I'm using my personal card. That's going to keep things easy. It's kind of like this church and state, whatever you want to call it, just separate it out. So those are just a couple of practical tips. But yes, technically you need to keep a receipt. So there's a lot of apps that are great for it. You can even just take a picture of it if you need to. By the way, the new features on iPhone are so easy. You can search the receipts by the date. A lot of the search features on just the camera roll in your app is pretty great. So that could suffice as a good record too. Now, you're a CPA or accountant, which you should be working with, by the way. If you're making money in your small business, do not be doing this on TurboTax by yourself. Go get a competent accountant or CPA to help you. Main Street Tax Pros, my partner, Mark J. Kohler in our law firm, he's a CPA too. He's got an amazing network of Main Street accountants out there that know these strategies, are helping clients implement these and do their returns. So get over to markjkohler.com. He's got the Main Street Tax Pro network. We can maybe drop that link in if any of you need an accountant that freaking knows this stuff. But your accountant doesn't need the receipts. They just need to know this was a business meal, or this was the 50%, or this is 100% category. It's up to you to kind of keep that record. So lots of people have different systems for this. Obviously, bigger businesses have an actual expense reimbursement form and a whole process for this. But a lot of self-employed business owners, I like to just work from the calendar, make sure your calendar is clear about what the business meeting was, take a picture of it, use the business card so you know it's a restaurant expense and it's going to be a meals expense. But the better organized you are, the better off you're going to be in the event of an audit. All right. Any other questions we got on topic?
Yeah. Mac from YouTube. Can you give us a small, quick, and dirty example of when someone would opt for the actual versus mileage?
Yes. Let's say you're a contractor and you want to buy a truck for $50,000. You've had a great year. You made 300K this year and you're like, oh man, I'm in the 37% tax bracket now. I want to reduce my taxes. I wasn't paying in enough. And I actually need a truck in my business. The one I've been driving or the one that one of my team or the people I work for me use is falling apart and it's more costly to keep. Go buy the truck already. Not only is that good for your business and it needs it, it's going to cause you less hassle. It's going to be a great write-off. So for example, if you bought the $50,000 truck, $60,000 bonus depreciation, that's a $30,000 write-off right there, in addition to the actual expenses of using it in that year. So that's a great write-off now. So that would be a good example of actual. Now, if you're like, Matt, I'm going to drive 5,000 miles this year business, and I'm going to drive 15,000 personal. Just do mileage. Do not do actual. You actually won't qualify for actual. It's got to be used 50% or more for business. And you want to go for the ones that have the bonus depreciation, which is the SUVs and trucks, 6,000 pounds or more. So that'd be the down and dirty one. I think the contractors are the ones that need the trucks. They typically use them 50% or more for business, and they qualify for the bonus depreciation. There you go. Final answer. All right. Anything else in the hopper on questions? All right. Okay. Well, thanks everybody for the amazing questions. I hope these 5 strategies help you know which tax deductions to use that are audit proof, that can help you on your return today. Make sure you're subscribed to the channel because I'm going to be coming back with more updates and information on these topics. Now, let's get to the other questions. If you have any other that are off topic, please throw them into the chat. I have some questions that came in advance that are not on topic. So I wanted to hold these to the second part of the live today. And let me just hit these here. This is a question from RMDB. He says, for the Corporate Transparency Act, any idea if the home address will be visible with the Freedom of Information Act request, or is this data non-public? This data is not public, okay? A Freedom of Information Act request, which I know we have that, you know, this all First Amendment and the government needs to disclose everything, not individual personal data. The way this is getting treated is similar to like a tax return. Like someone can't make a Freedom of Information Act request for your tax return. The only way that your BOI information, which by the way, if you don't know what we're talking about here, this is the Corporate Transparency Act. This is the new law that for LLC owners, S corporation owners, you have to make a federal filing saying who owns or controls your LLC or corporation. So if you have an LLC or corporation, you've got to file this BOI report to a Department of Treasury agency called FinCEN. One of the things on there, like this question is asking, is your home address. And so, but that is not public information. Federal government agencies and law enforcement can share it, and they can only share it actually with state law enforcement agencies with a subpoena from the state or a court order. So Freedom of Information Act requests are not going to be enough. Your information will be private with the federal government or, again, state government agencies if they get a court order. All right, Bobby asks, this is in the Team Wealth Live questions. By the way, we do have a Facebook group. We're going to be using it more in the future. So get over to Team Wealth Live. We're going to be building a community there of like-minded investors trying to build wealth. We'll have strategies, challenges. It's going to be awesome. But we're getting to that in the second half of the year. Already a lot of you over there. We appreciate that. Keep throwing in your questions there. Bobby asks, there's a question about when I started talking about when to start self-directing your IRA or 401k, which is something we have clients do all the time at our company, Directed IRA. You know, we opened up 500 accounts last month, 750 new accounts the month before, and all those people are using their IRA or 401k to not buy stocks or mutual funds. They're investing in a small business or a rental property or a real estate deal or private lending or crypto. They're buying non-publicly traded assets, which your IRA can do. Tons of other content on that. If you're like, what are you talking about, Matt? We got a lot of other content on that. All right, but Bobby's question was, what are some of the items that people invested in through their self-directed IRA when they first started investing, when they were trying to build up their account? Well, I'll give you my own personal example, and what we see most of the time is the most common person that's self-directing their retirement account is someone that's already had a retirement account for a few years, at least. Even my own example, I started putting money in my retirement account, and it took me 3 years. And I was just investing in the S&P 500 until then. I was setting money aside, making my annual contributions, getting the money in. And finally, I hit the point where I had enough to go do a real estate deal. I got up to 40,000 in my account and I bought my first rental property with my self-directed retirement account. Same thing even with my Roth IRA. I was doing backdoor Roth IRA contributions for 5 years before I did my first deal. Okay. And so it takes time to build it up. Most people who are self-directing, though, are rolling over from a broker-dealer IRA or an old employer 401k. That's probably 80 to 90% of the accounts in the self-directed space, us and any of our competitors included. So, but you've got to start somewhere. Everyone that has a self-directed account, a directed IRA, started at zero. It's just what did they do their first few years or 5 or 10? Everybody's different as they're starting to save and set money aside. Then they self-direct later. Now, we do have clients that are like, hey, Matt, I could, with $5,000, I could do a deal. I could wholesale a real estate property. I could do a crypto trade. I'm just a more entrepreneurial deal maker type person. And those clients can, 1 year of a Roth IRA contribution of $7,000, they're off and running. They don't need to wait multiple years of contributions. Me, Matt Sorensen, I got 150 employees, businesses to run. I'm more of a passive investor. I'm actively interested and involved, but I'm not like a deal maker where I see deal opportunities where I can pull a deal off for 5K. So everybody's a little bit different. All right. Any questions there in the chat, Tristan?
Yeah. We got another question from Mac. He wants to know, can a person use a PO box for the address portion of FinCEN since there will almost certainly be a data breach in the future?
No, you cannot. You have to have a physical address. You cannot use a PO box, unfortunately. And I know this is just, all I can say is like, write your congressman and senator. I mean, if I was in Congress, I would have voted against this. I think the law is freaking stupid. It makes no sense. The whole purpose of this was for money laundering, this FinCEN BOI rule and requirement. But frankly, if you're a money launderer, you're not filing this, or you're going to file it with bogus BS information. So I don't think it's actually going to move the needle, and it's just going to cause a ton of compliance for small business owners. But we have to deal with it. So I'm filing them. I already filed on most of mine. And obviously, we're helping clients every day do it. Any new entity we're setting up in our law firm, KQS Lawyers, you have to file this BOI report in 90 days after the entity is set up with the state. It's automatically included now when we do an entity, an LLC or a corporation in our law firm. We're doing it from day one, so it's taken care of and done. Also, for all of you in the past that have entities, by the way, there's 30 million entities in the U.S. Those of you out there have existing entities before 2024, you have until the end of the year to file this BOI report. And we have a whole company compliance business. My law firm partner, Mark, and I have a separate business called Main Street Business Services. All it does is company compliance for LLCs and corporations, doing state renewals, doing annual minutes, providing registered agent service. We also do your BOI filing as part of our company compliance service, which is $200 a year. That includes your minutes, it includes your renewal to the state, and it includes your BOI filing, the initial one. Plus, if you ever need to amend it, it includes the amendments. So you can get that service over there if you want to engage someone to handle it for you. That's mainstreetbusiness.com. Just go to mainstreetbusiness.com and you can get connected with our team there. You can book a call right there. We'll drop the link in for any of you that want someone to handle it for you. But you can do this at fincen.gov yourself too. You can do it on your own if you want. The form's got 5 pages to it. There's steps, but it's not rocket science. But our kind of message has been, hey, go be a business owner. Go figure out how to make more money in your business. Let us handle the compliance stuff. Even your annual renewals and your annual minutes. Don't be stressing about that stuff. That's not worth your time. Just let our team handle it. It's $200 a year. We take care of it for you. All right. Any other questions popping up from the live? Okay. Let me hit one question that came in from on the HSAs was, can you expand more on the qualifications to get an HSA? Yes. So an HSA, you must have a high deductible health insurance policy. Now, the deductible amount changes every year. And so I'm just going to look it up what it is for 2024. Tristan, you might help me here. HSA high deduction policy amount. It's adjusted for inflation, so it goes up every year. Now, it's not just the deductible. It must also be HSA qualifying.
Minimum 1,600, maximum 8,000. Families 3,216.
Okay, 1,600 and 3,200 single family. That's how high the deductible needs to be. So in other words, another way to think about this, if you have like a really low deductible health insurance plan where your deductible is $500 or $1,000, that doesn't qualify for an HSA. HSAs are meant for people that go after higher deductible plans because they're planning to use the money they put in the HSA to cover their out-of-pocket medical. That was the concept of why Congress created it. It wasn't for everyone. It was for people who said, hey, let me get cheaper insurance that's high deductible, and I will cover that gap from zero to that high deductible amount, 1,600 single, 3,200 family, out of pocket. And I'll use the HSA because I get a tax deduction when I spend that money. Now, you don't have to spend the money. That's the nice thing about the HSA. You put the money in, you get a tax deduction. It's not use it or lose it like an FSA where you got to spend it out by year end. It can continue to invest and grow and build up. You can use it in retirement. That's a great tax planning, wealth building strategy right now. Great strategy for retirement. That's one of the largest expenses you will have in retirement is healthcare costs. Using an HSA is a great way to do it, whether it's prescription drugs, office, like office visits, dental, long-term care, skilled nursing, even certain Medicare premiums can be paid with the HSA. This is an important thing for long-term wealth building. I like to think about it for saving taxes today because I put money in, I get a tax deduction today. Doesn't phase out regardless of income. So that's the HSA. Must be high deductible plan, 1,600 single, 3,200 married, or if I should say family, in terms of the deductible amount. All right, nothing else in the hopper right now. Okay. Okay, this is a question also on the HSA from News Johnson. Says, precise and to the point, well done. Has anyone actually withdrawn from an HSA? What does the proper tax-free withdrawal look like? Or does it assume that you mark this on your tax return on a yearly basis if you use it? Okay, great question. Typically with most HSA providers, they're going to have a form that says, hey, tell us either where to send the check or payment, or here's a reimbursement form. We actually just do a reimbursement form. I think it's the easiest because just spend the money out however you want. Use your personal checking account, pay the medical, and then we will reimburse you back. So you got to indicate that this was for medical expenses in the amount. We just have a form you fill out, and then we send you a check reimbursing you back. Now you can have an actual debit card. A lot of HSA companies that frankly just have a savings account where you're not actually investing the HSA money. We don't love that, but you just have a debit card. It's automatically tracked on the debit card. And so they will send you a tax form saying, here's what you withdrew. And they're assuming it's for qualified medical. Now, if they see you taking like a cash advance off of it or something, or, you know, using it at a restaurant, they're going to be like, that doesn't work. And it's not a covered expense. But so there's different ways you can do it. So let's say you did a reimbursement form with us. We would send you a tax form, but it's not taxable. So there's a form that HSA providers file to the IRS every year that says, hey, here's how much this person put in their HSA. Here's how much they took out. And as long as that taking out was for qualifying medical expenses, it's not taxable. Now, if you took the money out for not a non-qualifying medical expense, there's a penalty and you take the gain into taxable income. So don't take it out for non-qualifying. But if it's coming out for qualifying medical reimbursed, it's non-taxable, but you will get a tax form on it. All right. Okay, I was looking over there to see if we have live questions. All right, I want to make sure everybody knows, please subscribe to the channel. Get over to YouTube no matter where you're listening right now. You might be catching this on LinkedIn or Instagram. Get subscribed over my YouTube channel. You'll get updates from new videos we're putting out, new times we're going live. You can comment on any of the videos there. I tend to pull a lot of those comments for the questions. Also, make sure you get signed up. Team Wealth Live over on the Facebook page as well. We're going to also look at changing the format, the time to 4 p.m. Pacific time. We're going to be testing that in the next few weeks. We've been doing noon. We might be doing 4 o'clock. We'll see how it goes. But thanks for those of you who have been listening and shifting around on that. We're just going to see how that goes in terms of what's best for the audience. We're just doing a little bit of testing on that. So bear with us as we're bouncing back and forth. But it's going to stick to Mondays. That's the best day for us and for our internal team studio and everything else. All right, if there's no other questions, I'm going to sign off right now. We're going to be back next Monday, of course. I think we're going to be doing 4 o'clock, but stay tuned. And if you're